G'day everyone, welcome to another weekly general update for the 28th and 29th of April. And as usual these days, another pretty interesting week that we've just had. We certainly had resolution of a couple of things, particularly the S&P, which has broken to a new short-term high, so highly likely that it's now telling us that the corrective phase is over in the US market at least. Anyway, let's have a look at that. But first of all, just a reminder on the general advice nature of this information. So a quick summary for the week. The S&P net rose 25 points on the week, so it was quite a strong week and a very good finish. So technically, this marks the completion of the correction. Now that guarantees nothing. It just means that the overwhelming odds have now shifted towards the fact that the correction is now complete. Earnings season has been very strong relative to expectations. The expectations for profit growth across the board in the S&P 500 was a little less than 1% growth in profit, and I think from memory it came in at around about 11.5%. So yes, expectations were extremely low, but 11.5% growth in profit is very strong no matter how you want to argue that case. We also saw the fact that the market is responding in a pretty broad-based manner because the Russell 2000, which is an index of small and mid-cap stocks in the States, is also continuing to look very strong, and the banking index as well is also very close to its medium-term highs as well. So really it's across the board in the US. Moving on to Australia, we lost 4 points on the week. Our market we had a bit of a brief period there where our market seemed to play a bit of catch up, but look, we really can't get out of our own way at the moment, and fairly disappointing, down 4 points on the week. So the break of 43.50, which was technically significant, is holding, but only just by the skin of its teeth, and it won't take much to see the price of our index back inside that range, but then that doesn't necessarily tell a story about individual stocks. So in the past month or so, it's really all been in the banks and the energy stocks where the rise has been, certainly not in the major miners. Now the other thing that happened last week is that small cap liquidity, which has been on the slide for probably a month, really collapsed last week, and particularly in the last couple of days. There's still a few stocks moving, but by and large not that many. So that means that we just need to be really cautious about what we're doing in the small cap space. Let's just have a look at those couple of charts before we move on. This is the S&P 500. This is the structure that I've been showing now for quite some time. I was expecting an ABC correction to the downside, which I guess in a way is what we got. This is the A leg, the first one down, then we got a B leg, and then we started to get a C leg, but it's been chopped off at the knees. It's only gone down basically to form a short-term double bottom. It's now moved up again, and Thursday and Friday closed above the high of April 17, which has now created a new short-term high. Therefore, by definition, the odds are we're back into uptrend. So the next stop for me is 1440, and then depending on what the market does around that level, it then could push on towards 1500. So certainly sentiment in the States is looking pretty good. Let's just have a look at those other couple of indices. This is the Russell 2000 on a weekly chart. You can see that it's really been moving very strongly since October. It's really been consolidating since February, so it hasn't really done much, but last week was a fairly strong week. So that's a good sign coming out of the earnings period. Beg your pardon. Now let's have a look at the banking index. So this is the US 500 banks on a weekly chart. You can see very strong, and whilst this index doesn't go back very far, it's basically now at all-time highs. It's the highest close that we've ever seen, and a very powerful week for the banks. So across the board, movement in the States very strong. Let's have a look at our market. This is our market on a daily chart. You can see the resistance area here, which has now become support, shown by this 43.50 area. We've broken above it, spent it 2 or 3 days around it, had a stronger day on Thursday but was unable to hold the gains, and we gave back even more on Friday and closed right on the lows. So our market really particularly disappointing, and certainly the materials index, which is really a major reflection of BHP and Rio, finished down on the week, and again right on the lows. You can see it seems to be forming a base, but a base with, let me just get some lines happening here. It's forming a base, but there is a downward bias to the peaks. There is a bit of a downslope to that. So whilst it's hard to fathom because BHP and Rio are already so cheap, if you want to look at this technical pattern, you'd have to say at the moment you would have to put the odds on this breaking to the downside. That's not a strong opinion, that's just an observation that that I've seen from looking at lots and lots of these charts. So certainly there's no really good positive news in the technical side of the major miners. This is the financials on a weekly chart. You can see there's been a definite upward bias over the last 5 or 6 weeks. It's not great, but at least it's heading in the upwards direction, whereas the material stocks have been going the other way. And I'll just see if I've got a chart of the energy stocks. No, I don't have a chart of the energy stocks queued up. So just going back to the presentation. So bond yields, which are important for setting global stock market moves. We saw Spanish 10-year bond yields stabilise a bit last week. They're still holding under 6%, but only just. And you've really got to ask, what is the ECB doing in the background to hold that under the 6% mark? I suspect they're doing something. Italian 10-year yields also just holding. They're higher than they were a month or two ago, but holding around about the 5.7% mark. These are not great levels, and it's the trend that's important, but at least they're not over the critical areas yet. US 30-year bond yields have slipped back. They're still sitting around about 3.1%, so no breakout there at this point in time. The US dollar finished lower on the week, and that certainly helped commodity prices on Thursday and Friday. Now let's look at gold. Had quite a reasonable week, rose $22 for the week. It's still consolidating around the bottom of a triangle, as we'll see on the chart in a minute, and we really need to see a break above the 1690, 1700 mark to signal that we're into a new uptrend. But we did see the GDX and GDXJ indices in the States moving higher again on Friday, so if we can just get them a little bit further, they'll be forming a new short-term high, and that will confirm the reversal. Oil did very little on the week, but copper rose back above 380, which is a very, very positive sign. So let's, this is copper, as you can see here on a 6-month chart. We had a fairly important level at around about the 380 mark. That broke a few weeks ago, but we've now moved back above it fairly promptly. So that was what I was looking for, so that's a really good sign. So let's have a look at gold. We'll look at gold on a weekly chart. It's a bit easier to look at. You can see we're still in this triangle. We're to the bottom end of that triangle, and we really need to see a break above the 1700 mark and above these previous peaks back here in March to signal that we're heading higher again. Let's have a look at the GDX index, this is on a daily basis. You can see we had basically 3 days higher. We completed the week with 3 higher days last week. But encouragingly, the junior miners probably did even a little bit better. So that's a good sign that money is moving back into the juniors, and it's way overdue, well overdue. Now let's just have a final wrap up from a strategy point of view. As I've said before, the reason that I look at the S&P index is because it really does set global sentiment for around the world. It doesn't necessarily mean that our respective markets will follow in the same direction, and we've seen the Aussie market pretty much underperforming for the last year or year and a half. But at least we know if the US market is positive that we're not going to have any nasty downside in our market. Looking at Aussie stocks, large caps still struggling outside the banks, and to my mind the banks are getting a bit overbought at this point in time. There's been a bit of euphoria about interest rates coming down in Australia and how that might help the banks' profit margins. But other than the banks, large caps really not doing anything that's really tradable. And small caps have also lost liquidity in the last week or so, and without liquidity the small caps aren't going anywhere. So extreme care needed now in that small cap space. So this part of the slide hasn't changed from previous weeks because the situation is still the same. I believe it's very prudent to hold some cash, because in this kind of environment any little trigger at all, when there's not much liquidity around, will trigger some fairly significant falls, some fairly sharp falls, because there's just no buying there to hold the price up. So we're going to see some great opportunities in really high quality stocks, and I would really encourage you to focus on high quality stocks rather than the penny dreadfuls, because it's the penny dreadfuls that can fall 20-30% on the open if we get a bit of negative news overseas. There's still a few gas stocks that are worth trading, but again, the entry and exit technique now is far more critical than it was a month ago or 2 months ago. So there's still opportunities. They're harder to find. There's less of them. You need to be more stringent in your entries and exits. And some of the concepts that I've been talking about lately with reversion to the mean and those sort of concepts need to be used to an even greater extent. So still fascinating times, still opportunities in the marketplace, but you've just got to be a lot more discerning about them. So that's it for this week. Cheers.
If you want to trade and invest with us with a big edge on the market, go to our website, specialistshareeducation.com.au. You can access our free video series on creating trading cash flow and smart investing. Plus, you may also register for our weekly Ask the Expert webinar.